Hello value investors, thank you for joining me. Today we're going to talk about IBM and why I believe IBM is actually fairly valued. So we're going to talk about IBM's revenue growth rates, then we're going to touch about the announcement came last week where the company is splitting up. Then we're going to talk about its cash flows and we're going to bring this all together and talk about its valuation. So let's get started. So IBM announced that its Q3 results were down 2% year over year. That's on a GAAP metric. Now, if you've been an IBM shareholder for a while, you become quite accustomed to it underperforming. So this would not be a large move on the stock in either case. Also, according to the analyst, the announcement last week, this was already preliminarily discussed already. So there were no real surprises here. Again, what the company is really talking about is splitting up. So it's going to have a smaller company, which it has its infrastructure business, and that's going to be most likely with no growth. And it's going to be a legacy business with strong cash flows. I suspect that a large portion of the debt will go over to the new company, and then you're going to be left with IBM, the leading cloud business. That would incorporate the Red Hat business as well. That's going to be growing at approximately mid-single digits. So that's the idea here. So does that immediately mean that today's shareholders are going to be positively rewarded as the two companies get their own multiple asserted to them? Well, that's a difficult argument to make. So let's focus here, right? So on the surface, when we look through, we can see that its cash flows for the year are quite strong, right? So the company's cash flows are stronger than its GAAP earnings, so by 130 something percent, 136%. But that's because a large portion of the working capital is being squeezed out. So I showed there that for the trailing 9 months, the working capital on the red arrow was negative 3 billion, whereas in this year was only a little bit less than that. But what's starting to happen right now is that's starting to reverse. So you can see here in this quarter, compared to year over year, the cash flows on the green arrow were negative 1 billion, whereas this time around was 1.6 billion. So that working capital that was getting squeezed out in the first half of 2020 is actually starting to reverse back out. So on the surface, investors are kind of getting a bargain because they're only paying 11 times trailing free cash flow. And in today's stock market, you're not getting many opportunities that are really being priced on that level of cheap free cash flow. But on the other hand, the free cash flow is only worth something if it can grow. If the business is slowly declining, it's not worth a lot. So that just brings it all together. So on the one hand, you are getting a business going to be split up, but I don't really believe that just because the company is splitting up and you can put the image that the business is more nimble, that the market will re-rate positively the company. So I think that at close to 110 billion market cap for IBM, when they get split up, you might see a little bit of upside, but it will not compensate the shareholder enough to bring new shareholders into the new company, to bring new shareholders to the new IBM, to really drive the share price up. So on balance, I think that it is quite fairly valued already. If you haven't done so already, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, with balanced argument for the stocks I own. Thank you for listening. See you next time.